Hello, good morning, everyone. We're going to get started, so if you can grab a seat, that would be great. My name is Matt McCleary, and it is a pleasure to welcome you to our 25th annual Ship Finance Forum here in New York. We have a fantastic day together. You know, we're at a time in the world where there's a lot of change, or certainly the possibility of change, and really appreciative to have this opportunity to sort of get together and talk about some of the things that are going on in the world. As always, our goal is that you will learn a few things today, get some ideas, ideally, see some old friends, and also, make some new contacts as well, because I think we all would agree that, relationships are really absolutely critical to kind of long-term success in the business. So if there's anyone you'd like to meet that you haven't seen, it'll get very busy throughout the day. Please let me know. I just want to say a couple quick thank yous to a number of people who've really helped put this event together. We have the privilege of organizing the events, but it really is a sort of a group effort. Our partners at DNB, Ted, Andrew Showett, Jim Cirenza, have been just fantastic partners in this venture. All the sponsors that you see on the slide, I encourage you to do business with these people. They are very devoted to our industry, and we appreciate their support. And of course, our speakers who it's really a generous thing for the speakers to put in so much time and effort to travel here and kind of share their perspective and their views. So I really appreciate all of that. So this year we're going to do something a little bit different. We've actually asked each of the speakers and moderators to pick their walk-on music. Who's familiar with walk-on music? Everyone? Yeah, so this has been cool. We've never done this before, but we tried it in New Orleans last week, and it was a lot of fun. So you're going to do country music here? Well, you just got to wait and see, Barry. So it really has revealed a lot about the speakers and their session. So we're looking forward to that today as well. So to kick it off, I'd like to welcome Jim Cirenza from DNB, and he's going to just kind of set the stage. And when Jim is finished giving his presentation, then we're going to call up a panel that Jim will moderate. So Jim, thank you. Take it away.
Yeah, where was it? Actually, the walk-on music is back to black. And when you hang around shipping and energy a lot, which we do at DNB, these last 4 years have been much better, back to black. First of all, on behalf of DNB Bank and DNB Investment Bank, I want to thank Matt and Mike and Lorraine and the Marine Money team. I want to thank all of you here today for joining us. It's a privilege to be able to represent this industry. DNB, we focus on 3 sectors internationally as a bank and as an investment bank. We focus on energy, we focus on shipping, and we focus on healthcare. We've got to throw healthcare in there because the other 2 are so brutally cyclical that we need something that works when other stuff doesn't work. It's been 4 incredible years. Second half of 2020 through the first half of this year it was 4 incredible years where everything worked. And even in the first half of this year for us, whether it was the debt capital market deals or the equity capital market deals that we did or the M&A deals that we're involved in, like the BWLPG, Avance Gas, the first half of this year was sensational. And the last few months have been something less than sensational. But that's shipping and that's energy and that's things that touch that space. But these are the spaces that we choose to be in, and we've been involved in these spaces for decades. I want to talk a little bit about the markets. I want to focus as much as I can on energy and energy shipping. And I want to talk a little bit about the difference between sort of the equity markets, bond markets, commodity markets, currency markets, because they're all telling us different stories. So white swans or black swans, I guess it depends upon which of these markets you're paying attention to. So if we start with where we were back on September 30th or October 1st, where the pollsters were telling us that we don't know who's going to win the House, we don't know who's going to win the Senate, we don't know who's going to win the White House. But the markets figured out, starting back on October the 1st, that Trump was going to win. And you had a dollar that rallied over the course of, so this is a 6-week stretch from October the 1st into the second week of November. You had a dollar that rallied 6%. You had an equity market that rallied more. In fact, NASDAQ rallied 8%. You had Tesla that went up 30-something percent. You had Bitcoin that went up a lot. You had a euro that took a hit. You had the European equity market take a hit. You had the Chinese equity market, which exploded in September, contracted massively, giving back about 40% of what it gained in September and October. And so the market correctly priced in the Republican win and the Republican sweep, and we priced in a lot because that, if you want to call it the Trump trade, that Trump trade started losing momentum a week after the election. And shipping, which is going to matter, whether it's tariffs or trade wars or, how slow or how fast does China grow, shipping's going to matter a lot. And if it's drill, baby, drill, certain segments like LPG and LNG, you would think would do really well. But as great as shipping performed for 4 years and as much ground as we lost from June until October the 1st, even with the Trump trade coming on, it didn't really matter what segment you were in. So I picked all U.S. listed securities. I picked a dry bulk stock, a tanker stock, an LPG stock, an LNG stock. What did I leave out? And a container stock. And you would think that the outlooks for each of these would be very different, maybe LNG and LPG in similar fashion, but you would think for the most part the outlooks for these would be very different, but the share price reactions were poor and remarkably closely aligned. And I find it hard to believe that we're going to stay that way for a terribly long period of time. And we'll find out with my next panel, we'll find out in certain segments whether the container activity into California is picking up now in advance of concerns of tariffs later, if some certain other things are being pushed back. So we'll try to get some granularity around these issues. The gap between sectors remains very wide, but the good news is, other than technology, it's a lot tighter than it was 2 years ago. It's a lot tighter than it was a year ago. If I go back 2 years ago, the last 3 sectors of the S&P over on the right-hand side were all trading in single digits, and right now the only one left in single digits is energy, which, whether it's energy service, energy transportation, that to me sticks out like a sore thumb. And I'll be very surprised if over time that valuation gap doesn't close further. But we've seen what I believe is the start of an interesting rotation. If I go back 2 years ago, you can throw consumer discretionary up there in the mid-20s in terms of EV to EBITDA multiples, so that's enterprise value over earnings. And the average right now is 17. We'll come back to, we'll touch on that in a second. But you look at technology and you think about the Magnificent Seven. We just finished with NVIDIA's numbers last night. So if I take the Magnificent Seven in this third quarter, their earnings are up 20% year on year. If I take the Magnificent Seven in Q1, their earnings were up 50% year on year.
What earnings are you looking at there? Current?
Yeah, the third quarter just ended. Okay. So each of them, we got the 7th of the, so their earnings year on year up 20%. First quarter, their earnings were up 50% year on year. If I take the other 493 stocks, in the first quarter, their earnings were down 1%. If I take the other 493 stocks in the third quarter, which we just finished, well, we're about to finish, those earnings are up about 1%. So yes, the earnings have been driven largely by those stocks, but their earnings growth is suffering from just the law of big numbers in the past. The comps are getting tougher and tougher, and the earnings growth isn't what it used to be. And I struggle with 28 times EV to EBITDA as being a reasonable measure. So I think this rotation is going to continue. No matter how I look at the S&P, it's expensive. And there's a mistake on there, that EV to EBITDA, which says 88 percentile. It's supposed to be 98 percentile. There's always a typo in a deck. But I'm not a big fan of price earnings. It's the easiest one to mess with. You buy back shares. But even price earnings is at the 80th percentile over the last 20 years. And every other metric. Warren Buffett loves the market cap to GDP down at the end, and that's up in nosebleed territory as well. So the market's expensive, but the equity market has benefited from a couple of things. It's benefited from lots of ownership within the U.S., lots of ownership outside the United States, U.S. as well, and it's benefited from a massive passive wave of investment, which we'll touch base on. You know, we used to have really long cycles. We used to have cycles that would last sometimes a decade or more, and now lately we're having really short cycles. You see the contraction from where we were in 2021 down to 2022 and then back up again. And so the next typo is that last green bar, which says 17 times EV to EBITDA. The green bar should obviously be higher. And to put things in context, back in the year 2000, when the market popped from a valuation bubble back then, we were trading at 14.3 times EV to EBITDA, so we're expensive. Here's the rotation I'm talking about. Back on July the 10th, the Magnificent Seven made an all-time high, struggling with those levels today. The yen troughed at 162, the Nikkei made an all-time high, NASDAQ made an all-time high. And we had a violent reaction in the first week of August when Japan raised rates. And I think that started a meaningful rotation. And if you look at what's happened since that first week of July, the IPO index, so the chart to the left, that's a year and a half chart. So that takes you from January of 23 up until July of this year. So that's a year and a half chart, and the outperformance of the NASDAQ 100, which what I put up there, compared to the IPO index, compared to the Russell 2000, which I think of as being the real world, that outperformance was phenomenal. And now you look at what's happened since then, the NASDAQ 100's at the bottom, and the IPO index and the Russell 2000 have outperformed by at least 15% over the course of the last 4 or 5 months. And it's not just, I'll get to my next point in a minute. The US market, relative to Europe, relative to Asia, has never been this expensive. In the top chart, we're trading at 22, 23 times earnings, and most of Europe and the rest of the world are trading in the teens, and the UK is trading at 11 or 12. The bottom chart is price to book. We're trading at over 5 times price to book. The rest of the world is trading at 2. UK and China are trading at less than 2 times price to book. So the gaps in valuations have never been greater. Why anyone would ever want to list their company on any other exchange than a US exchange is beyond me, but a real US exchange. This is going to be tough to see. These are the shares outstanding in the Russell 2000 index and the shares outstanding in the S&P index. The point of this chart, and your eyesight needs to be better than mine, is it's not just that we've had this 15% outperformance over the last 4 or 5 months in the broader market relative to those stocks, but the money flows have gone that way too. So even though we are in a market where the passive investment relative to the active investment is mind-boggling, we've passed the 60-40 mark as it relates to equity assets in the US institutionally, and we've passed the 50-50 mark if you include equity and bonds institutionally. So the passive money, which goes into index and ETFs, so it's good to be big enough to go into an index or an ETF. So if you just break it down by group, each of those is active minus passive. So another way to look at it is breaking it down active and passive without having one subtracted from the other. And these $500 billion plus swings we've had in the last couple of years are incredible. We got to move along. There are 3 things that have worked really well for the US economy in the last year and a half. Government spending has been a shocker. Consumer spending has been surprisingly strong. And in the recent quarters, the spending on services has been surprisingly strong. Manufacturing, not good. There's other pockets of weakness, but those are the 3 pockets of real strength. And if you looked at the GDP numbers in the last 2 quarters, government spending was 1% of that figure. I mentioned the consumer, surprisingly strong. US dollar, strong, but it's a long chart. Weak euro, weak yen, and weak Great British peso, as I call it. So yes, we have a strong dollar, but I think the story is more the weakness of the other G4 countries. Speaking of G4 countries, wow, they bought a lot of securities in the last decade, 15 years if you want to be exact. They certainly bought a lot of securities coming out of 2020. So that's the G4 countries, so it's Japan, Europe, UK, US, and that's in trillions of dollars, like $25–30 trillion worth of holdings. And so those holdings are coming down. At some point, I think it's going to be difficult for everything to go up. You know, we've had a stock market that's gone up, and we've had other things that have struggled. We've had commodity markets other than gold that have struggled. We've had bond markets that have struggled in the last couple of months. And so we're getting to a point where maybe everything can't go up at the same time anymore if the central banks are taking money back. But in the meantime, if the central banks, particularly the US, need dollars, if the Treasury needs dollars, and the foreign flows into the US stay positive, it's hard to imagine why the dollar would go down. There are pockets of weakness. Job openings are one pocket of weakness, but we're only back to pre-pandemic levels. And so my view going forward is the IPO market is very encouraging. The M&A market is becoming more encouraging. And this rotation from the Magnificent Seven into other sectors, I think it's got legs. I'll wrap it up there, and we'll switch over to my panel. Thank you.